Hello and welcome to today's edition of The Final Bar. We're going to have a guest, Sam Burns from Mill Street Research in Boston. Sam's more of a market strategist, so I love hearing his take. The visualizations, how he sort of goes about visualizing the markets, but what he's seeing right now in terms of a macro perspective on the equity markets, how that relates to other asset classes, which will be really, really compelling. Bit of distribution in the morning, but a nice recovery in the afternoon. So what does that mean for the long-term trends? We're going to answer all those questions and more. Ladies and gentlemen, this is The Final Bar. Hey everyone, welcome to today's show. I'm Dave Keller, your host. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks so much for joining us today, every weekday after the close, to look at today's trading from a technical perspective, think about how it relates to the long-term trends, the big picture of the markets. My guest today, Sam Burns, very excited to have him on because he is less of a technical analyst, less of a technician, more of a strategist. And I've always found, when you think of some of the other guests that we've had on, I love people that are able to think about the technical perspective, help us connect that to what else is happening in the world. So I think this is a really compelling time to have that conversation about things, especially with today. We're having a segment called Charting Currencies, which I'm really excited about. And I think the story right now there, thinking about the markets, is the strength in the dollar. And I think there are a lot of themes out there that are related to that dollar strength you might not be as familiar with as you could. So we think about commodities, we think about U.S. outperformance of global markets, think about weakness in Japan, all of that related in some way to dollar strength. Coming up on the show and on StockCharts TV in the next couple of weeks, we have a lot of really interesting guests, interesting shows. Starting this Monday, we'll have our next episode of Behind the Charts featuring Craig Johnson from Piper Jaffray. On February 26th, next Wednesday, we have Julius DeKempener with the Sector Spotlight Show coming to join us here. On the 27th, I'm very excited to welcome Axel Kabar on the show. He's a technical analyst from Bulgaria. So talk about a different perspective than many that some of you have heard. That'll be exciting to hear his take on global equities. Then the week after that, we have Scott Smith from Briefing.com. Starting on March 6th, the Final Bar is actually going on the road. We're going to be going to the Traders Expo in New York. And so a couple things are going to happen. Number one, we're going to capture some fantastic interviews that we'll share with you, some on this show, also some for Behind the Charts later this year, digging into people's processes, their backgrounds, their overall market approaches and outlooks. But we also will have some special guests on this show helping us update on the market activity. So some of my fellow StockCharts TV hosts are going to come on the Final Bar, help me update you on what's going on with the broad market. So it should be a really cool week coming up in a couple there starting March 6th. Let's get to our market recap and talk about what all has been happening. So, you know, today, again, I feel like every day when I'm firing things up and looking at the charts, it feels like a quote-unquote unusual day, and today was no different. You had sort of this choppy move out of the open. So when I'm first getting started, I'm actually at home firing up the laptop, looking at what's happening. So this is 6:30 our time local here. You can see the market sort of jumped us up a little bit, and I'm thinking, all right, maybe a little bit of a follow-through on with what we saw, happening yesterday. But then all of a sudden, the big capitulation, the big sell-off there, starting 11 a.m. Eastern, a little before that, coming off to bottom out just before lunch. And then we have this slow and steady climb on there. So that pushed the S&P overall still down on yesterday from yesterday's close, but only down just over 1/3 of the percent, 0.38%. Mid caps and small caps both up. We actually caught this earlier today. We did our YouTube live Q&A this afternoon, and we talked about how the broad market was down, but mid and small caps were actually up. That's sort of where they finished. So if you can see the little preview chart here, mid caps actually got back into back in black, sort of back up to 2106 for the mid cap index, which is a decent move higher. So some of the smaller, more speculative names doing better than the broad market, which is a little different. Let's look at a chart of the S&P very quickly, and then we'll move on to some other themes. So this is today's trading. You can see the range was much wider, almost double the normal range for the S&P today. And we chopped around, but in the end didn't go much directionally, sort of closed lower than yesterday's close, lower than the open, but it had been a lot worse, sort of came up. And so the momentum going into the close was certainly more constructive than destructive, showing some appreciation. And this pushed us back into that range. Yesterday, it felt like we were breaking out, closing to new highs, new intraday highs. We talked about a new push forward. Today sort of feels more like a digestion. We're sort of in this range, which I'll now call like 33.40 to 33.90, sort of that range that we've played out in the last 7 sessions. So until we are able to sort of break out and see momentum shift one way or the other, that's sort of where things are at. I think at a big picture level, you can still see this bearish divergence of higher highs in price, lower peaks in the RSI. That still is in place for the S&P and many, many stocks out there. And I think that's certainly a potential area of concern for bulls. In terms of what's happening below the hood, let's go one level down. On the sector basis, you can see that some defense was at the top here, real estate, utilities. At the bottom, we had tech, communication services. This sort of evolved during the course of the day, but it really ended up being more defensive at the top and more offensive at the bottom. So sort of felt more negative than positive just on today's trading. In terms of some themes that have popped out here, just looking at the charts, and again, not to get too close into what I think we're going to talk about later, but with our guest Sam Burns, but thinking about sort of that global asset allocation picture, has it felt to you recently like kind of everything's going up? And the reason is because that's kind of what's been happening. This isn't a look at the major asset allocation. If you look year to date, which is just the sort of vertical line here, about 4/5 of the way across the page here, that's sort of the end of last year, beginning of this year. You can see the big sell-off in oil. That's the big outlier here in January. But in February, pretty much everything's going up and to the right. The dollar's stronger, oil stronger, bonds stronger, gold stronger, stocks stronger. Now, again, there are plenty of things that have gone down, but the broad indexes, the broad assets that we tend to track, all have been net positive. And so, the concern I have, and I guess the real question now is, that doesn't tend to be sustainable. Things don't all move in conjunction, highly correlated for very long. Things start to unwind. So the question is, where do we see weakness, right? What starts to disagree with that bullish thesis? Where do we see some breakdowns? For me, thinking a lot about equities, I'm looking at the sort of lines in the sand on a lot of equity charts that I'm following and seeing where we might see some sort of movements. In terms of stocks that are moving in the news, just thinking a little further about a recap here, just a number of themes to hit with you. One of the top stocks today was ETF E-Trade, which is essentially announced a buyout by Morgan Stanley. So a huge gap up. So in our scooter rankings, jumped up very, very quickly because of this big gap that moves all the indicators much, much higher. A little sell-off into the close, but overall it's driven up pretty big. That was a huge deal. If you look at Morgan Stanley, you can see it's actually weakening on that news. Sort of had shown this pretty compelling sort of mini cup and handle type of pattern, sort of a pullback to support here, a little shallower decline in the last couple days, but this is now pushing it lower. But again, as long as it stays above 52 and the 50-day moving average, which is around the 52 to 53 range, staying above there still keeps it into a bullish configuration. I'd be watching the RSI as well, which is back down nearing that 40 level, which tends to be a good pullback in a constructive period. Solar stocks all doing very, very well recently. We had a nice up move in the solar ETF, which is ticker TAN, and then a nice follow-through day today. So a lot of the solar stocks actually appreciating very nicely. You can see the relative strength. If you've not watched this space, the relative strength is really accelerated to the upside. So it's up a pretty big way. It's up 43% relative to the S&P in the last year. You can see it's sort of in uncharted territory up and to the right. Extremely overbought right now, which usually suggests at least a little bit of a pullback, but overall further upside momentum because the momentum to the upside right now is so strong. And you can see relative to other ETFs, the TAN ETF, solar ETF, is one of the strongest anywhere. Just cycling through some other names that caught my eye as I was looking through some of the charts today. Harley-Davidson has been sort of an underperformer. It's been a name that a lot of people had been following, especially back here in the fall when it started to really retest previous highs, but it failed. Now below 2 moving averages, but look at how it sort of reverts. Now we have a higher low, and as of today, we now have a higher high, closing back above the most recent swing high from the first week in February, now reclaiming the 50-day moving average. RSI back in bullish territory, and the relative strength just starting to turn up. So if you're looking for names that are earlier on in that uptrend, something like HOG might be an interesting one to pay attention to. A lot of energy names moving around, and so it's funny, the chart of Marathon Petroleum, MPC, looks very similar to the chart of HOG recently, where you have higher lows, now a higher high, breaking above the most recent swing high. This is a bit of a different profile because you're facing this, what I call a supply area, an area at which sellers have come in before. This is just above the 61 level, which we're approaching here. So, will be interesting to see if it's able to push through those that resistance level, or if it hits resistance and holds there. Hormel is a name that's down. Obviously in earnings season, we've got a lot of quick movements, a lot of gaps. Hormel HRL is something that jumped down very quickly, now back below the 50-day. And again, gap days are not something to be afraid of, just something to be aware of. And I think the most important thing is tomorrow. Do we have a follow through to this distribution, or do we see people buying in on the weakness? So I think closing below the 50-day is step one. Sort of having a follow through, a confirmation of that downside is it can be pretty interesting. Gold miners actually all doing very, very well today as well. Actually, if you look at the member dashboard, look at the groups that are up the most. Gold mining and mining are the two groups that are at the top of our list of the Dow Industries. Newmont Mining, NEM is something in that gold group, obviously. So on the day when the S&P closed down a little bit, Newmont Mining up 4%. Gold stocks are interesting because they're out of benchmark for big money managers, so you have to go out of your benchmark. It's an unusual bet to be buying gold stocks, and so when they rally, it's actually a really compelling play because it's a way that they can generate performance outside of their normal allocating around their benchmark. So interesting to see gold miners up a lot. Newmont Mining up significantly over 4%. Approaching that extremely overbought level, which is what I'd be looking for on NEM. So I hope you don't mind. I sort of tore around through a lot of different stocks, but as I was looking through the markets, found a lot of interesting names and interesting charts to highlight. So I want to go quickly through as many of those as I could. That's it for our market recap. I want to go to our next segment, which is called Charting Currencies. As we talked about this show and about the ways that we could slice the markets from a technical perspective, I realized very quickly that thinking of different asset classes would be helpful. So we've done some segments on commodities, on ETFs, on fixed income, on bonds, and now here we're going to do one on charting currencies. And we'll do this regularly just to refresh what we're seeing from a technical perspective, how to think of it. When I'm looking at currencies, I tend to go to this chart list. This is my intermarket analysis list. It's really based on, reading John Murphy's book years ago and thinking about how, I should visualize these different things. So there are a lot of charts that I've created, but in the end, starting with the candle glance and just seeing what's moving and where they're at in their cycles has been very, very helpful to me. So down here is where I'm looking at my main two currencies to look at, which is the USD, $USD, which is the long-term US dollar spot index, and then the UUP, which is an ETF based on the dollar index, and I'll show you those very quickly. So $USD is the main thing that I would look at to understand the long-term trend in the dollar. And if you've seen the show before, you've seen how I've talked about it. These blue arrows sort of illustrate this cyclical pattern that you saw the beginning of 2019, again over the summer, and then going into the fall months, you had this similar sort of pullback, a nice run up, and then this correction. These are all the same length, so you can see it's a similar percent pullback each one of those three times. This third one was actually very different, though. The first two times were very similar. You had a reclaiming of the previous highs, looked very, very almost identical. Then you had this sell-off to the 200-day again, but we never really got back to those previous highs. You can see we never got above there, and the RSI remained in that bearish territory, never really getting above 60, which suggested that the momentum had shifted, and overall it was more of a bearish phase and less of a bullish phase. Then you saw the dollar break down through the 200-day here in December, retested in the end of December, and go to new lows going into the holidays, right? Since then, though, it completely turned on a dime. You can see it was oversold just before the new year, and since then, it's been on an absolute tear, and this week has once again reclaimed the highs from last September and last October. So the US dollar went from being a weakening dollar story going into year end. I remember recording my market outlook and talking about dollar weakness and how that might play out and what you should look for. Boy, since then, the dollar completely reversed course, right? You saw instead of a resurgence of Global markets, emerging markets, you've seen a continued weakness of them because of the dollar strength. So what's interesting right now in the dollar index is it's now almost extremely overbought, and that has not happened in a long, long time. Generally speaking, when a market becomes extremely overbought, RSI above 80, you'd expect a bit of a pullback, but overall, the momentum still remains very, very positive. And so I think that's what we're potentially looking at here. We'll have to see over the next week or two how that actually plays out, but that's sort of the base case. So when would you look at the UUP? So for us, those dollar indexes, the currency indexes are long-term and they're updated once a day. The UUP is a great way to get a read on the dollar performance intraday. So if you just want to see what's moving, if you look at all of our screens, we show the UUP as a way to just visually represent that. So you can see that the dollar actually continued to strengthen today. The UUP is actually with an RSI almost right at 80, which tells you the extreme upside momentum. These disconnect if you look at a longer-term trend just because of the way that the UUP is constructed as an ETF. So the US dollar index is the way to do it. Now, what other things could we look at? If we do $EUR, this is looking at the dollar relative to the euro, and you can see that it looks very similar to the dollar chart, and that's because the dollar index, the way it's weighted, depending on how you look at it, is very much tied to the euro. So it's essentially showing you the performance of the euro because it's a big, big weighting in that index. This is not the way that the euro actually is usually quoted. It's usually quoted this way, $EUR/USD, because you usually quote the euro in terms of the strength of the euro relative to the dollar. So the EUR going to new lows shows you the weakening of the euro versus the US dollar. This sort of confirms that US dollar strength story that I was telling you. So again, sort of suggests favoring US markets over non-US markets if you're thinking about the equity side of things. This is the dollar yen. So you usually quote this $USD JPW. And the way you usually quote this is dollar to yen, which means if this is going up, tells you the dollar is outperforming the yen. If this is going down, it means the dollar's underperforming the yen. So this spike that you see right here is the yen weakening severely versus the US dollar. That's why the dollar index is going to new highs. That's why this is going up as well, because it's showing you dollar strength versus a weakening yen, and that's why this chart, the EWJ, which is the ETF for Japanese equities, is breaking down, right? So you see a weakening. Japan actually hit resistance just above 60. It was never really able to reclaim it, retested it here, but now you have a lower low and now a lower peak, and now another lower low here. We sort of have continued to gap down over the last 5 or 6 trading sessions. So overall suggesting relative weakness, and if you look at the relative strength, which I'm not showing here, but if you look at the relative strength of the EWJ to the S&P 500, it's been, been incredibly negative because, again, relative weakness. So as I go through some of those charts, it might be a little confusing, and I tell you, it certainly is the way that currencies are quoted. The way that you can do them, if you do $ and then any 2 currency symbols, you can do euro to yen, Aussie dollar yen, you can do any combination that you want. These ones that I just walked you through are some of the main ones that I would pay attention to. And again, just think about which currency you're putting where. That'll show you what you're looking at relative to each other. And again, the main thing that I'm seeing is dollar strength relative to global market weakness. And that's why this chart looking at the US market in black and all the other global regions in blue, this is EFA, in green, this is frontier markets, in red, this is EM. You can see them all lower peaks rolling over. That's because of the strength of the US markets and the US dollar relative to global currencies. That's our segment on charting currencies. We're going to take a quick commercial break. Be back with my guest, Sam Burns from Mill Street Research. We'll see you in a minute. Hey everyone, welcome back to our show. Thanks for joining us every weekday after the close for The Final Bar. I'd love to get some of your questions. Just email us at thefinalbar@stockcharts.com. We'd love to use them in a future mailbag segment tomorrow. Also, you can just put a question real quick in the Q&A during the show today. We'll make sure we capture those and address those in a future broadcast as well. I want to welcome on my guest, Sam Burns. Sam is the founder and chief strategist at Mill Street Research based outside of Boston. Sam, welcome to the show.
Oh, thanks, Dave. Appreciate it.
So it's been a pleasure to get to know you and your work. And what I am enjoying most just about reviewing what you're doing and getting you on the show is, I mean, as I'm sure you know, this is a very technically oriented program where we're talking a lot about the charts and what they mean. So helping us frame out how the charts relate to sort of the macro perspective is so important. So I loved your first chart looking at basically central bank positioning. What is this telling you here?
Yeah, I think this is kind of one of the key charts I've been featuring because I think a lot of what's going on in the markets, and you mentioned earlier that how everything seems to be going up, at least a lot of the financial assets have all been rising at the same time. And the reason is that basically central banks are pushing liquidity into the system, and in many ways for the purpose of holding up asset prices and trying to stimulate growth and inflation, certainly among the developed markets. And so that rise in central bank assets, I think, is one of the key drivers of why equities in general have been doing well, particularly U.S. stocks, because the Fed has been the key factor that has swung, that's really driven that sort of aggregate number up higher recently. Back in October, as you may remember, they started buying Treasury bonds again, Treasury bills, I guess, as a way to add reserves to the banking system and keep interest rates from spiking. And that's had a sort of a knock-on effect on all assets. So we've seen stocks across the world as well as bonds all rally at the same time because there's now a lot more liquidity in the system, and it's showing up in asset prices.
You know, it's such a great thing. This is one of those things that I think people are less aware of when you're just looking at the markets and looking at what's moving. You don't think about the impact of something like this, but you're absolutely right. This is the kind of thing, this going up, so showing that positioning is what could actually create this phenomenon where it feels like everything is appreciating, right?
That's right. Yeah, no, and it is very much what you'd expect in a liquidity-based environment, meaning it's not, strong economic growth that's driving things and making stocks go up. Earnings last year were basically flat for U.S. large caps and, down somewhat for U.S. small caps, and so the same was true generally globally. So it's not that you've got strong economic growth and earnings that are really the driver. It's because the central banks are pushing money into the system and the interest rates are very low, so there's really no competition or much less competition from fixed income, for equities, and the money kind of has to go somewhere. So people are piling into to bonds and to stocks, and so you've seen even that the long duration U.S. Treasuries, like the TLT or the 0Z ETFs, are up 25-30% over the last 12 months, and have actually even beaten stocks, even the U.S. large cap stocks, because there's been so much buying within fixed income from a lot of this liquidity that's going on, and the fact that the bond investors don't expect inflation, they don't expect the Fed to raise rates for the foreseeable future. So there's really no sort of structural risk from a policy standpoint to buy stocks or bonds from this standpoint.
So how do you relate that to the second chart you sent, which is looking at global growth indicators? How does that relate to the chart number one?
Well, so here is basically these sort of market-based indicators of what what global growth looks like. So things like the yield curve, which tends to steepen when growth picks up. Industrial metals, materials prices, which tend to go up when growth goes up. The dollar, which I've shown inverted here, tends to strengthen, meaning the line would be going down, as you were commenting earlier. Dollar tends to strengthen when growth slows down. Crude oil is on the low end of its range. Gold, which I'm showing also inverted, has been rising. So all those are typical things that happen when growth is slow, inflation is low, and the central banks are trying to stimulate, and that's what we're seeing right now. So basically, the issue globally is that growth is relatively weak. Central banks are trying to prop it up, but the markets don't see any real sign of a significant turn in the overall growth outlook. Things are likely to be sluggish, and if anything, maybe risk of slowing down more rather than speeding up from what the markets are telling us here, on these indicators. So that's why I think, large cap growth in the U.S. is outperforming. People are paying up for growth stocks. Same thing globally, the U.S. outperforming the rest of the world because there's stronger growth in the U.S. than, say, in Europe or Japan. So I think there's a lot of these things all fit together. Weak global growth, a lot of central bank stimulus, low interest rates, pushing people into equities, but into the larger, safer, higher growth equities that they can find.
So we only have 30 seconds left, Sam. This is fascinating. I'd love to know how you would relate what we just talked about to defensive leadership, right? So you've had technology that's obviously been in a position of leadership, some communication services names, but certain days you see real estate, you see utilities bubbling up to the top. How do you reconcile that, people paying for growth, but also the defensive side of the ledger also doing pretty well on the equity side?
Right. I think the defensive side is definitely taking, getting benefit from the low interest rates and the central bank, support. People looking for income and stable growth. The tech and healthcare and places like that are the only places, that you can find any kind of real earnings growth anymore, kind of secular, structural earnings growth. Whereas the traditional cyclicals, the commodity areas, the industrials, and some of the consumer stocks have really struggled, to produce growth and are kind of out of favor now, and probably will stay that way for a while. So I think tech, growth and some of those defensive sectors are the areas that we've been overweight in our recommendations for a while. I think they'll probably continue to, have the most support as long as growth globally is relatively weak and people are sort of going to be willing to pay up for stability and growth in the equity market.
Sam, these are fantastic charts and really, really appreciate your perspective. Thanks for coming on the show today.
My pleasure. Thanks for having me.
That was my guest, Sam Burns from Mill Street Research. A great perspective, thinking more. And again, I've always enjoyed talking with people like Sam who can connect what we're seeing with the charts, the visualization of the markets, with all the reasons, all the things that make the charts do what they're going to do. So fascinating work. We need to move on though and wrap up the show with our 3 in 3. So at the end of every show, 3 charts in 3 minutes. If these are not on your radar yet, I hope they are as of this moment. Chart number 1 is the U.S. dollar index. We talked in our segment on charting currencies about this theme of stronger dollar, and Sam certainly highlighted that related to the global growth story. And so, for me, from a technical perspective, it's all about where we're at relative to where we've been. And the fact that this pattern has now resumed of a stronger dollar environment, the weakening in the euro, relatively speaking, and nearing that extreme overbought region, which really shows you the extent of the rally that we've had. It certainly has felt as an exponential rise, and the RSI being so extremely overbought tells you that has certainly been the case. So from a dollar perspective, we're definitely in uncharted territory in terms of the relative movement that we've seen recently, but it's firmly in the bullish side of the camp, suggesting that the trend is certainly on the positive side. Chart number 2 is looking at EM, the EEM ETF. This is the MSCI Emerging Markets ETF. What's interesting here, and again, thinking technically, as the U.S. market has remained in a position of strength, still at or near all-time highs, you've seen EM sell off pretty dramatically. When it broke down through the 43 level back here, third, fourth week in January, I thought that was pretty significant. Since recovered a little bit and felt like it was kind of re-emerging to go back to those previous highs when commodities start to look kind of interesting in the month of February, but you can see in the last week that sort of reversed back downwards. We're back below the 50-day moving average. The RSI never really got above 60, and on a relative basis, I think this is the real story, right? Even if you think emerging markets are bottoming, you're not getting paid for it on a relative basis. Still, with the dollar strength, with all the other things we've talked about, it still pays to stay close to home as a U.S.-based investor for now. The final chart I'll show you, we actually didn't talk. I was so caught up with all these other things we were looking at. We didn't talk a lot about healthcare in our market recap, but I think the pharmaceutical index, ticker DRG, is an interesting one to watch here, only because it's testing the 50-day. And we talked yesterday or the day before about Toll Brothers, one of the home builders. I think it's interesting to look at example charts that are at a key juncture, right? So something like Toll or something like pharmaceuticals pulling back to a key support level. And the question is, does this hold? Is it able to hold the 50-day, resume this uptrend, or is this a breakdown? Does the RSI remain above 40, or does it break below that, suggesting that we're more into a bearish phase? Does the relative strength start to stabilize, or do we make new relative lows for the last 3 months? And this is a chart I'd want to follow to see which of those two things happening. And again, if we see these charts like this break down, see home builders breaking down, it tells you that one by one we're starting to see more chinks in the armor for this bullish case in equities. If they hold, it tells you that we can remain long and strong, remain pretty confident in the continued outperformance, continued movement in that growth story. And ladies and gentlemen, that is our show, The Final Bar, for today, a Thursday afternoon. I want to thank you all so much for joining us every weekday after the close for The Final Bar. Please keep your questions, your feedback coming to us. thefinalbar@stockcharts.com is the best way to get your ideas or your questions. Also, just take a minute, if you have it now, go into the Q&A segment on the screen and enter some questions. We'll be happy to consider them for our mailbag segment tomorrow. You can look us up on Twitter @FinalBarSCTV. We'll love to share with you who's coming on the show, share with you some of the things we're going to be looking at during each trading day. We just had our YouTube live Q&A this morning or this afternoon Eastern time at 1:30 p.m. Mark your calendars Thursday for 1:30. If you go to our YouTube channel, hit subscribe, hit notifications, you'll get a pop-up on your phone on the website when we're going to be taking your live questions on the YouTube platform. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great evening.